Hey guys, welcome back to another week of Mortgage Matters in Minutes. Again, I'm your host, Brent Rasmussen, and today's Mortgage Matters in Minutes is coming to you here live from Mortgage Specialist. So today we have some very exciting news, as we don't always get to come to you and explain that things are getting better. Generally in the home lending world, things can always get worse. And today we're going to talk about government loans, which is our FHA and VA loans, and they are getting better. And what does that mean? It means it's getting cheaper for you in regards to making monthly mortgage payments for these types of loans. We've been expecting this, and we've been talking about this here in our office for many years, because we do evaluate what's going on currently and what's going to happen in the future, so we can always make the best decisions for us. This is a great item that's coming out now because, again, we're still in a low supply environment, but there's also scenarios where certain properties need to be picked up, and they might only be able to qualify if someone is looking at FHA or VA, and that always hasn't been the most prominent loan or the best loan for the sellers, which we've talked about before. But today we're going to chat about the different changes that have occurred. And first, what are those? So let's talk about what the VA funding fee is. It's a fee that's charged on behalf of Veterans Affairs, similar to mortgage insurance. We chatted about this a couple of weeks ago, that they charge in order to keep the loans for VAs moving forward. Because for all loans, we have to pay and insure for the insurance risk, which is if the borrower doesn't make the mortgage payment. So a VA funding fee allows for that. And FHA charges MIP, mortgage insurance premium, where conventional loans charges PMI, private mortgage insurance. So what we're going to talk about today is in the government loans, the VA funding fee is going down for certain people, and the MIP, mortgage insurance monthly, is actually going down as well too for consumers. So let's kind of chat about that. Is that in November of last year, or it's been going on for many years now, FHA looks at how much insurance money they have, just like any insurance agency, whether it's car insurance, life insurance. They calculate out what is the chance that we have to pay out on claims and how much money do we have saved. And if we have enough saved, the government states that FHA must have at least 2% saved in their statutory limits. And they right now have over 11%, 11.11 is what was calculated back in November. So they have nearly 5 times the amount of money that they need in order to, perform on behalf of the government's statutory requirements. So because of that, once they build up enough money they have set aside for any foreclosures that are going to happen, they don't need to charge the consumer as much money. And that's what's occurring here, as they're lowering the number because they have enough set aside. If foreclosures all of a sudden ramp up and they have to use that money, they might increase the FHA mortgage insurance. But right now, the case is that mortgage insurance are very, very low, and they have enough money set aside so they feel comfortable in lowering those amounts. So let's chat about what those amounts look like. I'm going to do a little share screen here, I hope. And we're going to talk about here, the very first slide is going to talk about our VA funding fee. And our VA funding fee takes effect, the new changes here, on April 7th of 2023. So just a little bit down the road here, a few weeks. But on the left-hand column here, we see is the old amount. And the old amount is generally most VA individuals use VA loans to purchase homes, and they put down the 0% down. So if you put more money than just the less than 5% down that's highlighted here, the mortgage insurance goes down. It's not crazy expensive. So if you are a first-time user of the VA loan, and you're doing the 0 to 4.99% down, your funding fee changes from 2.3 down to 2.15. And we've seen that very lower in the past, but this is what the numbers look like now. And as you can see, those numbers go down in columns. If you use the property or use the VA loan for the second property you're purchasing, and you do the 0 to 4.99% down, it goes from 3.6 to 3.3. So it's also great for consumers there as well. All the numbers in these columns have gone down. So this is a great change for VA loans, and veterans that are taking this on is making this loan less expensive for the individual. So what does this really save the individuals? We kind of did a quick math on a $300,000 property, let's say if you purchase a property, loan amount's at $300 and your funding fee there is at $6,900, that gets rolled into your loan. If we're looking at the right-hand column of the same purchase price of a $300, same loan of $300, if you're putting that 0% down here, your funding fee goes from $6,900 to $6,450. So you're saving there $450, which is great in regards to you paying less over the life of the loan. So let's do a quick comparison now and look at FHA here as well. So FHA is their MIP, their mortgage insurance premium. This changes here on March 30th of 2023. And actually, it's March 20th of 2023. Sorry for the typo there, but it's March 20th of this year here, where the old mortgage insurance is generally, when most people take out FHA loans, they look at the least amount down, which is the 3.5% down. So if you put down less than 5%, it goes from 0.85 to 0.55. So you're lowering by about 35% on each month the outflow that you're paying there, basically. So let's look at how this is going to calculate out to real savings for homeowners. And that's what we really want to see here, is what is the real savings. So both of these comparisons here are a $300,000 loan, or actually $300,000 home price. You're looking at the loan amount here of $294,566. So with a monthly mortgage insurance on the old prices, you're paying $208.65. Now you're going to be paying $135.01 per month. So you're saving $73 every single month moving forward. That's huge for some people in certain price range. We generally say a $1,000 home price changes in $1,000 in a home price is about $6 to $7 a month generally. So this looks like, in kind of a quick summary, you can afford another $10,000 more in home price, which with home prices on the rise, that definitely can make a difference. Or it just allows the consumer to pay obviously a lesser payment per month. Hopefully that kind of makes some sense on those numbers. In general, you're not going to memorize the formula of every single time the mortgage insurance changes, makes adjustments, things like that. With FHA, there's a big chart, just like you saw with VA, that it depends on how much you put down. The more you put down, the lower the mortgage insurance could be, or the quicker it falls off. We know right now if you make the minimum down payment, FHA monthly mortgage insurance goes for the life of the loan. But as you make a larger down payment, it does fall off after 11 years. So these are the things obviously we want to educate you on, is changes in the market to make home ownership more affordable for you in purchasing a home, and FHA and VA might be the best fit and the best bet for you to look into at this point in time. So please let us know if you have any questions. Please subscribe to our Mortgage Matters in Minutes here weekly at 3 p.m. on Tuesday afternoons on our YouTube channel, Instagram, or LinkedIn and Twitter to be able to watch our updates each and every week. So have a great week, you all, and we'll see you here same time, same place. I'm Brent Rasmussen. Have a great day. Mortgage Specialists. Driven, trusted, reliable.